now we're look at insurance not just from a protective standpoint, what happens if something goes wrong, but unlike that property and casualty insurance, we can use life insurance as a tool for creating wealth as well. And so we'll get into that.
It can be very beneficial for business owners with their surplus income to pay premiums from their corporation into a cash value policy. So the face value, as we spoke about earlier, starts off here, but then the value grows over time. And not only does the value upon death grow over time, it actually accumulates a cash value. So not only is this an asset that these people can use for estate planning purposes, they can actually use it in their lifetime also as a very efficient way to complement their retirement planning.
Good day, Adrian. How are you doing today?
Good day, Trevor. I am well, thank you. How are you doing today?
I'm doing good, Adrian, but I do have a bit of a beef that I need to just air out here. And I know that I'm going to get probably a lot of comments here. Most of them are going to be from my wife, who's not going to like what I have to say here. Last night, we were out trying to get a few last minute Halloween yard kind of objects and different things. So we went to the Home Depot, and I thought that was a good place to go. Not one Halloween ornament out anymore. Full on Christmas.
Oh, no. Yeah. They can't bring Christmas out before Halloween's over. November 1st. Like, that's the rule.
And the Christmas music's going. And I mean, there's like 12 songs, and we're already hearing them in, mid-October. So, this is not I hate Christmas thing or whatever, but just let Halloween go past. It was a little bit early. We went to like 3 different places before we found some stuff to put on our lawn. So it was all full of Michael's and Walmart and you kind of name it, and it's full swing Christmas. I think it's just a little bit early, but other than that, doing great.
I agree with you. I think that's crazy, but interesting story. I think we've got an interesting guest on today. Today we're going to have Kelso Beggs, who is a financial planning and relationship management specialist for a company called PPI. And the way I think of it, PPI kind of goes in between many individual insurance advisors like you and I are both licensed for insurance, and in between a bunch of different carriers. And they're the conduit that kind of allows all of these advisors to reach all of these carriers that kind of fit in between. So he's got a lot of perspective about life insurance. And so that's what we're looking at today.
Yeah. And I'm really excited to talk to him. And, I think most people understand what life insurance is there for in kind of the traditional sense. And I really want to dig in a little bit deeper on how we can use this to help build wealth and create wealth in a tax-free or more tax-efficient kind of manner. So really excited to talk to him. So let's move on and get him on here and see what he has to say about using life insurance to create wealth.
Absolutely.
Kelso, so happy to have you here. I think, I think insurance just as an overall gets a bit of a bad rap. I think a lot of times we think about insurance and we think about, our parents or our parents' parents again sold the insurance policy by that traveling insurance salesman. And, so I think insurance has a bit of a bad rap overall. And we look at it from, fighting against the insurance company, the big insurance companies. And, my experience has been that I've had, clients that have passed away, and had they not had insurance in place, their family would have been in a completely financial disparity. So, having insurance, I've seen it firsthand how important it is. So I'm really excited to talk to you today about life insurance particularly, and, some of the different uses for it as well. So thank you for being here today.
Thanks, Trevor. And thanks, Adrian. Thanks for having me on.
Pleasure. So we're going to just jump right in here. I think part of what we need to do, just because there is a working relationship with you and us, is just kind of put that out there right at the get-go. So why don't you just give us a quick, 3,000 foot kind of view of what kind of our relationship is and your relationship with Harborfront, and then how that actually works, just so we can get that out there and there's, nothing hidden behind any curtains?
Yeah, sure. So I guess I'll start with I work for PPI. So we are, I guess, one of Canada's biggest MGAs, or we sometimes call ourselves an insurance marketing organization. But what do we do for yourselves? So we work with firms like Harbourfront and other firms, and I guess advisors like yourselves and planners like yourselves are super busy in the day to day managing money, and insurance risk management, estate planning is something that you could perhaps sometimes do with an extension of your practice. So I guess what I do is I do some of the heavy lifting for advisors like yourselves, or I can do. And so anything I can do to make your life easier, I do. And then I suppose behind me within PPI, we have a team of really clever people. So we have on staff, we have lawyers, accountants, actuaries, underwriters, and some people think, well, insurance companies have underwriters and actuaries. Well, we actually have them on staff also, because sometimes it helps us to determine the right carrier for the client, and sometimes it can help us also present the case in the appropriate light to the insurance carrier. So yeah, that's I think what I do.
Well, and I think one of the things you touched on there, kind of briefly, is that you guys, and I love this about where we are with Cherry Hill and with Harbourfront, is we're not beholden to any one investment. We're not beholden to any one insurance provider. And I think that's, one of the things that you kind of glazed over a little bit, is that you have how many insurance providers that you have access to, or through, and us through you?
Yeah, so I think it's in the region of about 20, and actually, people will tell from my accent I'm not from around these parts. But historically, I lived in the UK originally. I spent 16 years in Singapore, and there was no such thing as an MGA. What I do now. So I guess I would, doing my role, I would perhaps be working for a Canada Life or a Manulife,
Yeah.
saying that their solution is the most appropriate. But the great thing is now, because I have access to say 20 carriers, I don't care, which carrier somebody uses, and it's in my interest to make sure it's the best carrier, so that the advisor thinks, yeah, this is the best option, and the client also thinks this is the best option. So for me, it's great that there's no conflict of interest.
Yeah.
Perfect.
Love that.
So before we go too far down the conversation of insurance and lose all of our audience, I do think we want to point out that we are looking at ways to make money here. And this is supposed to be a discussion about insurance, but as a tool, as opposed to as a cost. And so we want to get into some of the detail about what that means, because that was very vague intentionally. And so I want to pull some of that detail out of you. And Trevor mentioned at the start there that insurance, sometimes there's some, negative feelings or apprehension about insurance in general. And I have my opinions of where that might come from. But I wonder what your thoughts are about, why do some people not like the word insurance? And can we, clarify that for them?
Yeah. I'm glad you kind of asked me that one first, Adrian. And my view on it, and obviously I know that both yourselves and Ashley in your practice all hold the CFP designation. Now that's obviously something that was very hard for you to get, but
Yeah.
but with that, there are responsibilities that you have as well. So you have to give holistic advice to your clients. If you can't, and by holistic, I should probably, for the listeners, I guess it's not giving advice on one thing in isolation. It's ensuring that if we give advice on this, is it going to impact other areas of our planning? So I guess a benefit to clients working with a certified financial planner like your practice is that you have to do the right research to make sure any recommendation is appropriate. You don't have to just look at one recommendation, you have to look at a wide range of recommendations, and you have to, I suppose, say why you went for one, but you also have to perhaps say why you didn't go for the others. So a long way of answering that question is, I think people historically have been sold insurance, as Trevor said, the salesman that met their parents or their grandparents. And clients 2 years down the line, they often question, why did I do that? And there was nothing in writing as to what the basis for the face amount, as we call it, on the insurance was, why they took it out, why they're paying for it. And in times of hardship, as we've all seen in the past few years, if people need to cut their cloth accordingly and reduce their expenses, if they don't know the value of something they hold, they'll stop paying for it. And that can actually be very dangerous for clients.
Yeah, and you touched on something there about the face value or the death benefits amount, and I've asked so many of my clients, I'm like, when I see an insurance policy that was sold to them by somebody else, how did you guys come up with this number? And it's just a blank look, and it was like, I don't know, that just seemed like the number that we should have, and so little goes into actually figuring out that why, and it becomes more of a commodity and a sales and a product piece as opposed to part of the plan. Like you said, part of our job as certified financial planners is not only making sure you have the right vehicle to get there, but also the seatbelts, right, to protect you and your family. Yeah. So that's where insurance comes in for us a lot of times as well.
And I think it's also about just the kind of perception people get from, and sometimes, home and auto insurance. Like I really feel like when you have a home and auto insurance, you're hoping you never ever use it. When you do need to use it, the insurance company is trying to pay you as little money as possible. They have to cover what they told you they would cover. But there seems to be a discussion of, we're going to cover this and not that, and this and not that. And that can be, disconcerting for a client, and they can share that with all of their friends, and then everybody kind of goes like, "Oh, I hate insurance." I find life insurance is much simpler because it's really down to, if dead, then money. Like, it's not a whole lot more complicated than that when it comes to paying out a claim. And so I think the perception, unfortunately, comes from a different piece of the industry, which we don't work in, and it infects life insurance in the negative. So. I guess the point is to dispel that intention here. Now we're look at insurance not just from a protective standpoint, what happens if something goes wrong, but unlike that property and casualty insurance, we can use life insurance as a tool for creating wealth as well. And so we'll get into that.
Perfect. Yeah, this is what really excites me, and Kelso, I think this is the reason why Adrian and I, initially reached out to have you on this. Is I think we can get into some of the other reasons to have insurance, either later in this conversation or at another time. But I was recently talking to a business owner client of mine, and they have this kind of elite wealth planning mastermind group that they're all a part of. And they had somebody come in and they were pitched the idea of insurance as an asset and a way to grow your money inside an insurance product, essentially tax free. So I'm really hoping that you can help explain to us what they might have been told in this super secretive elite behind the curtain thing, and put it out there for us, normal folk. So how was this used? Like, where would this be? So maybe you could kind of help enlighten us a little bit here.
Yeah. You know what? I will say, as a starter, a lot of the work that we do with clients is with business owner clients and successful business owner clients. Now, I've never heard of this elite group, but I'm interested to find out more about them. But yeah. You know what? One thing that kind of resonates with me, that for these elite people who've obviously got this time on their hands to have these discussions, is that a lot of our clients out there don't have this time to have these discussions. So they're absolutely reliant on, advisors like Adrian and yourself, Trevor. And, but yeah, so I guess what they're talking about is, I suppose, cash value life insurance.
That's right. Yeah.
So, I think we traditionally think of term life insurance that you take out alongside your mortgage when, if you've got young kids when they're young, and then when the kids are grown up and the mortgage is repaid, some people say they don't need that coverage anymore and they cancel it. Now, we can go on to talk about why they shouldn't do that as well. But the other type of insurance, the cash value insurance, is a type of permanent insurance. And it can be very beneficial for business owners with their surplus income to pay premiums from their corporation into a cash value policy. So the face value, as we spoke about earlier, starts off here, but then the value grows over time. And not only does the value upon death grow over time, it actually accumulates a cash value. So not only is this an asset that these people can use for estate planning purposes, they can actually use it in their lifetime also as a very efficient way to complement their retirement planning. Now, again, we don't want to go into too much detail here, but it's absolutely an option for these clients. And you know what? All of these elite clients, they have accountants. So accountants love numbers, and if this number looks better than this number, then you should really look at this. So, we can always stack up the numbers between this is what I'm currently doing. This is what happens if we add an element of insurance in, because we're not saying put all your eggs in the insurance basket, but we can actually show how adding just a portion of insurance into the mix can make the client's situation better.
Yeah, and I think, kind of what you touched on there right at the end, it's so important for people to understand, right? When we talk about diversification, a lot of times it historically it's gone to equities and income. And then we started getting into a little more geography and how much you have in Canada and the US and around the world and different pieces like that. Where we've opened it up to a number of different asset classes where we're now talking about, private equity and private debt and real estate and, different items like this. But I think what gets missed in those conversations, especially when you're investment minded and, you're not necessarily fully adapt in the insurance world or not up to date on what's going on there, is that you forgot that this could actually be a really good asset class in itself that's part of a very good diversified portfolio. And that's not necessarily saying 70% of your portfolio, just like I wouldn't put 70% in even a great company like Nvidia, who is killing it right now. And because at some point in time, you need that diversification. So do you have any idea on what's percentage or what kind of cash flow you would be allocating to this? Or is it just really dependent on who the individual is and what they're trying to accomplish?
Yeah. It is very much individual, as we know financial planning is. But you often hear your clients say, "Oh, my friend told me about this. I want to do the same." Well, let's stop you there. Is it appropriate for you? It could be great for them, but is it appropriate for you? But what we tend to find as a very rough rule of thumb is sometimes the fixed income component of a client's portfolio, and obviously as a client gets older, some of them become more risk averse. So we do a lot of planning with older clients, and it's probably good to kind of quash the myth now that older clients can't get insurance, because yes, as we get older, we're not as fit and healthy as we were in the past, but these insurance companies, they recognize that people are getting older. A lot of the planning that we do is with couples, so you can have a very healthy husband, not so healthy wife. They can both be insured on the same policy, and they can also get very favorable underwriting rates. You can even get somebody who's a complete decline, and they can be insurable as well on a joint policy. But in terms of the investment component of the insurance, and again I'll talk about fixed income, is that there's a type of insurance called participating insurance, and again that's where the value grows. It's something that the client doesn't have to manage that element of the portfolio themselves, or they don't have to ask yourselves to manage it for them. The insurance company manages it behind the scenes, and they actually have an asset management team doing this. It's not one of the underwriters doing it in his part time. So they will actually manage those monies. And some of the investments that you were talking about, the private equity, sometimes the people who are floating these offers, they go to insurance companies first and say, "Hey, do you want a piece of this?" Because they know that these insurance companies have got lots of money to invest. So these clients can actually, through insurance, access investments that they wouldn't ordinarily be able to access. And in terms of, and sorry to waffle on, but in terms of the risk, These assets, let's say they return 4% per annum. It's not taxable because it's insurance. And also, as well, if you look at the standard deviation, it's the same risk as, or very similar risk to, a 5-year GIC. So again, it is good asset diversification.
That's awesome. And so how is this paid out? I guess is it because if you're not investing in, because I think there's two pieces that people typically look at, and one of the ones that kind of got a lot of headway the last number of years, and it might have lost a little bit of favor recently, is that universal life policy. And so I think sometimes those two get mixed up, the participating versus universal life. And so what's the difference between those two?
Yeah, they do indeed, Trevor, and you know, and I think that, and again, universal life, there's no bad product, but universal life, you know, I think if people Googled it, you could find negative stories on universal life. So I think I said participating insurance, the client pays the insurance company the premium, and the insurance company manages the money on the client's behalf, and they have a strict mandate that they have to follow, etc., etc. So it's very well regulated and governed. Universal life is what I would call self-managed. So the client has to select themselves what they invest in. Now, they may have an investment advisor to help them with that, but what we found with universal life historically was it got sold to a client, as we said earlier, you know, you need one of these, this is great. Perhaps the advisor that sold it to the client used illustration rates that were, maybe they weren't out of whack with what return rates were at the time, but they weren't perhaps good longer term return rates, factoring how the client could get more risk averse as they got older. So I think there's a lot of clients that have had their fingers burnt with universal life. As I say, there is a place for it, but it has to be advised on appropriately. The client has to know exactly what they're getting. The underlying portfolio has to match their risk profile today. And of course, that has to be monitored and rebalanced over time.
Right. Yeah.
Yep. It's similar to the way pension plans are, right? A defined benefit pension plan, like the Ontario Teachers Pension Plan or HOOP or OMERS or even Canada Pension Plan, where it's done for you, is much more similar to whole life. And then a defined contribution pension plan, where you get a statement and you get a list of investments and you've got to pick those investments. And then if it goes wrong, it's your problem, is much more akin to universal life. And so it depends on how much control the client might want to have, how reasonable the assumptions were in the first place, and you know how much time the client wants to spend dealing with these things. I think a lot of people would argue that you know the Ontario Teachers Pension Plan is a lot more attractive for most people than a defined contribution pension plan where they've got to pick the individual securities. I think that it's probably roughly the same when it comes to insurance.
Yeah, I think so. Well, I think so too. Sorry, Kelso, you're the expert. And I'm going to cut you off here, but because it's just on what Adrian said there. I think you know the way you said it. If you kind of take in what Kelso said earlier about the big insurance companies having this access to different investment vehicles, and you know get into some of that access earlier, whereas inside the universal life policies, just basically a mutual fund, and a lot of those are pretty limited in what you're actually able to get. I remember looking at a client's, I think it was a Sun Life defined contribution plan, and they have like 6 or 7 different investment options. And that's fine because you have your employer that's matching, and you know you're getting all of that benefit to it. So to have a little bit of a limited amount is probably fine. But if you have the option between a universal life where you're going to have limited options versus the participating, where they're making all the decisions and getting first access, that might be the better option a lot of times.
Yeah, you know what? And it was, I didn't recognize it myself. And it was somebody recently, we were working on a case together, and they said, because somebody was saying, oh, the pros of universal life are this, the pros of participating insurance are this. And then they said, well, don't make it a decision of this or this. If the client wants to, they can have both, put 50% into both.
Sure.
Yeah.
That actually leads me a little bit to another line of questioning. Like we started this talking about the group of ultra rich entrepreneurs with their exclusive access. Regular folks can buy insurance too. Is the decision making the same for a regular person? How does it filter down through kind of the wealth levels? Would a more typical client buy insurance for the same reasons as the ultra wealthy entrepreneur? And is there any kind of trigger that would bring the desire to buy this kind of product to a given client?
Yeah, I think that's a great question. And again, Adrian and Trevor, I know that you look at the planning holistically. I've seen clients being sold, policies, and if we looked at the rest of their planning, they haven't maxed out registered plans, TFSA, any money they can pass efficiently to relations. So all I'd say is for your run of the mill client, as you do, when you've exhausted the other tax efficient avenues, if the client does still have surplus, then absolutely, insurance is a great option to look at. And again, you can always say, well, if we don't do the insurance, this is what the plan looks like, and if we do the insurance, this is what it looks like. I guess one thing we are seeing more and more of now for the run of the mill client is more and more clients for estate planning purposes are utilizing permanent insurance, because I guess they recognize, or their advisors they're working with are showing them a snapshot at their life expectancy of, this is what your estate is going to be worth. This is the amount that can be passed to your beneficiaries, and this is the amount that CRA are going to take. Now, there are opportunities to reduce the take that CRA have. Also, as well, another key one is a lot of the clients may have heard of the recent inclusion rate changes for capital gains. The one thing that it affected for run of the mill clients is their cottages. Mum and dad bought the cottage 25 years ago for this much. Property prices have grown here, and it's the one asset that is going to be taxable on death. And it's something that it sometimes takes, unfortunately, it takes both parents to die for the kids then to get the tax bill and realize that they can't keep the cottage. So that's one basic thing we do, but it's very important.
No, that's a good point with the capital gains and especially the cottages. I've got a few clients that have multiple properties, including cottages and things like that. And, it's something we talk about because like you mentioned a couple of times, we are CFPs. So we do, the full financial plan, and it's something we take into account. But I think a lot of people out there, forget about this or forget about how much that cottage has actually grown over time and the burden that it'll be for the next generation to actually take that and own it, and not only the tax bill but the cost of the cottage and upkeep and all these things as they're trying to build their own wealth. So yeah, having an insurance policy that can help out with that when mom and dad aren't there is probably a pretty key part of the financial plan that they should look at.
I think it's as well, like you mentioned earlier, Kelso, the idea of surplus income. Like these business owners, when they have surplus income, insurance is one thing they can do with it. And I think the same is true for people who are regular employees of a business. To the extent that they've fully funded their tax-free savings accounts and either have made RSP or pension contributions to the point where they're kind of done with that, if there's still surplus income, well, then you got to figure out what to do with it. And there's about 1 million different things you can do with surplus income, but definitely insurance is one of the options. And it depends on what the goal is for that surplus income. You can give it away, you can spend it, you can invest it. And if you're investing it, then we got to look at insurance as complementary to other options.
Yeah.
Yeah. And so on that, so let's get back to the as an asset class piece there a little bit, because I think it's something that people don't necessarily understand. And I think it is something that even, we talk about the run of the mill, kind of client, but I think there's a lot of clients that have that, $500,000 to, 2 or 3 million have put, good work into, building their assets and, have that TFSA that's maxed out. Maybe are starting to look at having, a lot of non-registered investments. This is now something that we should be looking at. But how does the cash value actually grow inside a participating life insurance policy? Does it vest day one? Is it something that can go up and down? Like how does that all work?
Yeah, that's a great question and something I hadn't mentioned, Trevor. So I guess every year the insurance company, the asset management team, they will do their reporting and say, this was the value at the start of the year, this is what we invested in, this is what it grew to. So they'll know what the return on the portfolio was in a given year. Now, the great thing about participating insurance is that if they have a year where they returned 15%, they don't always give all of that to the policyholders in that one year. What they can do is they can hold an element back so that in a poor performing year, they can top it up. And what that does is that's what keeps it so low risk.
Okay. And I think, so it gets paid out as dividends, correct?
Yeah, and to answer your other question, because obviously a regular investment doesn't have a floor limit. I guess if you look at all of the market events over the years, I can't even think. I know obviously 9/11 was an event where the markets tanked. Now, the positive side of participating insurance is that once a value is attained, it gets locked in. So the value can only ever go up. Now, there are some exceptions to that, and we'd have to go into detail on it. But if a client pays their premium when due, and they get a value and a dividend, it gets locked in, so the value can never drop. Now, that's great for those clients we were talking about earlier who perhaps want to use that insurance policy as a retirement asset, because what they can do is they can take that asset to a lender, and the lender will happily lend against that, and they'll sometimes lend them upward of 90% of the cash value of the policy, because the lender knows it's very safe for them. They know the value is only going to go up.
Good. And that was the other question I was going to ask as a follow up is so it's made all this great money. It's inside an insurance policy. How do you get it out to use it in retirement? And is that kind of the number one way is to borrow against it?
Yeah. So you can borrow it again. You can borrow against a policy via your insurance company, but that is assessable for tax in the year you do it. But the more efficient way that clients use is actually to take it to a third party lender, and they say to the lender, "What will you lend me against the policy?" Now, some lenders will say, because obviously they're borrowing money, there's an interest rate involved. Some lenders will say, well, you've got to pay that interest when it becomes due. It is actually possible for all of the interest to be added on to the loan. And at death, let's say the policy value's grown to 3 million. They've borrowed a total of 1 million, including interest. There's a balance of 2 million still available to be paid to the estate.
That sounds pretty good. And that's all tax free, right? Because it is. And I just want, I know we've talked about it, but I just want to hammer that down. This is a tax-free way to get the money out, which is
it is now. Actually, it's probably worth us coming on to this because again, it's not that well known, and even accountants don't always know this, and sometimes we come across situations where our in-house accountants have to work with advisors like yourselves to go and speak to the client's accountant to say this is how insurance works, because if an accountant doesn't know how something works, they're probably going to say to the client, don't do it, which in some ways means the client doesn't make a bad choice, but the accountant shouldn't be holding them back. So I'd always suggest to clients, if their accountant says, no, you shouldn't do this, tell them to put it down in writing why they shouldn't do it, and then they can bring that to you. But the one important thing I wanted to say was, when insurance is owned by a corporation, the death benefits will normally be paid to the corporation, and life insurance is one of the few things that will actually credit the capital dividend account within a corporation, so the notional account, and money that hits the CDA can be paid out as a dividend tax-free, because obviously the only way to get money out of a corporation is salary or dividend. But monies from a life insurance policy, again, there are some calculations around it, but generally when a life insurance policy is held for a long period of time and it pays out, it credits the CDA account, and then the monies can be paid out tax-free normally to the shareholder's estate, to their family, to get that money. So yeah, absolutely tax-free.
Money to my ears.
How big are some of these insurance policies? Like just for interest's sake, obviously, any of our clients are going to buy the appropriate size policy for their cash flow and their intentions and the needs analysis we've performed for them and all this kind of stuff. But give us the fun story. Like, how big are these policies on the high end? This is interesting to me.
Yeah. Every now and again we'll get presentations from insurance carriers, and they'll say, here's the policies that were sold in the last few years via ourselves. So I mean, I saw a list the other day that was about 3 years worth. And there was a policy that had a start face value of 100 million. So that's what it started at. It obviously grew from there. Now, the thing is, a client can't just say, I want that 100 million. They've obviously got to be able to afford to fund it. But this is insurance first and foremost. Yes, they want to use it. They want to use it as an investment, but they have to be underwritten. So what is the loss that is going to justify the insurance company paying out 100 million perhaps on day one if the client dies then, but actually down the road paying an even higher amount out? So I think it's one of those, again, Adrian, that each client's different, and whether the face value of the policy's got 5 noughts on the end of it or 6 noughts, sometimes the planning
for those here in Canada, those are zeros, right?
Sorry.
we got very English there all of a sudden. But so no, that's great, Kelso. Obviously it has to be justified. It has to be an insurance case first and foremost, with everything else behind it. But is there any benefits to paying those premiums early, to kind of overpaying early? Does that make sense, or is it just pay it out as you go?
Yeah. You know what? Again, it's not a one size fits all. But if we had, again, I was working on a case recently for an advisor, and I'll give you the flip side of it as well. But we had a successful business owner who'd accumulated, over say 15 years of lots of success. He had 3 million that he just wasn't going to touch, and he knew that upon death, that 3 million was going to be taxed to come out of the corporation. So they were looking for something to do with the money more efficiently. So for somebody who had that amount of money, they were able to fund a policy a lot sooner. And but then on the flip side of that, we had a client who, they recently established their business. They're 5 years in, they're going really well. But is that success going to continue? So yes, they're banking, 200,000 of surplus every year, but is that going to continue? So, I think the client who's already got that money and he knows he's not going to spend it, he can fund the policy earlier. He can perhaps be a little bit more aggressive, but the other client, then, that they perhaps need to pay things perhaps until they die.
Yeah. But if we're looking at it from a strictly, you can do it from that side, you've got the ability to do it. If we're looking at it from strictly growing that cash value, does it make sense to overpay early or pay?
Yeah. It would do, and again, it's probably worth us saying here for the listeners that this is tax exempt in the eyes of CRA. There are limits. You can't just pile as much as you want to into the policy. So depending on what the face value of the risk is, that will determine how much can go into the policy. But yeah, I would absolutely agree. If it was my money and I had it, getting the money into the policy sooner to work harder for me to compound would be a good route to go down.
Perfect. And just on that, and kind of going back to the universal life, I think from the participating life insurance side, and correct me if I'm wrong, it's more difficult to make that, to turn your exempt policy into a non-exempt policy, right? Whereas universal, it's a little more onus on yourself and the advisor, or the insured and the advisor, to make sure you're staying within those limits.
Yeah. So with UL, you can overfund it as much as you want to, but there will be, what they call an overspill into the taxable side account. Whereas with participating insurance, when we run our illustrations, the illustration software won't allow us to put more into the policy in terms of contributions that would place the policy, that would cause the policy to lose its cause the policy to lose its exempt status.
Good. I'm glad you got the exempt and non-exempt, because as I was saying those a moment earlier, I was going, did I get that right? I was like, exempt, yeah.
So I've seen a similar situation for one of my clients to what you were talking about there, where, piled up non-registered assets, and those non-registered assets are spinning off interest and capital gains and dividends, and those all have tax consequences. And, enough income was coming in to also push them up against the old age security limits. So they were repaying old age security. And so it made an awful lot of sense to try to hide some of this. Hide's maybe a weird word, because we're not doing anything nefarious, but try to move the non-registered assets somewhere where they're not going to create so much in the way of taxable income. And so we were very quickly able to overfund an insurance policy. And we didn't use all of the non-registered assets, but we got rid of enough of them into the insurance policy and changed the taxable position enough that the client wasn't repaying their old age security anymore. And that was, like, for me as a nerdy finance guy, it was really neat for me to watch that happen and to make it happen for my client.
Yeah, that's pretty cool, Adrian. Just being able to, and I think that really speaks for, what we do on our side from the certified financial plan, where it's just like, I've got a finance guy, or I've got an investment guy. This is really where, we can get creative and, do some things where we're not hiding, like you so aptly corrected yourself on, because it is, a great strategy that we can use to make sure that you're not having your OAS clawed back or paying extra taxes, giving more money to the government that is spending it so wonderfully always, and it's not a liberal or conservative NDP or anything, but our government typically has not spent our money as well as we're able to spend our money. So, be able to move it into, better avenues or better vehicles makes a ton of sense a lot of times. So that's a great illustration for that, Adrian. So I think, I don't know, Kelso, did you have anything else on the making money from your insurance side of things that you wanted to touch on that we didn't cover?
Well, all I would add, and not to be a plug for what we do, but I guess life insurance is just one part of what we do. There are the living benefits, things like critical illness and disability income protection, and those things also can provide a return. When we talk about things like return of premium, because as Adrian, you were saying earlier, people's experience of insurance is that if nothing happens to me, I don't get anything back. Well, there is the ability with some of the solutions to add on what they call a return of premium rider. And, if you do stay healthy, which is what we all want, it will actually pay you your premiums back, or a portion of those premiums back. So that's all I'd add there.
Yeah, no, and I love that, and I think we could spend a lot of time talking about the living benefits side, and I've had conversations with clients recently about long-term care policies and the whole gambit. Adrian and I both have a life insurance policy that pays us for staying healthy as well through the Manulife Vitality, and we get our Apple Watches at discounts, and if we stay healthy and hit our points, and we get discounts on our premiums as well. So there's lots of interesting things out there that, because ultimately the insurance company wants you to live longer and stay healthier. So, a lot of them can put in these little benefits to really help, kind of sway us to that with gadgets and gizmos and Amazon gift cards and the whole 9 yards. So yeah, there's a lot out there. I think we'll have to have you back to talk about, some of that side of it, and especially on the living benefits, because I think it's such an interesting piece that's not talked about nearly enough as well.
Yeah, I'd love to.
Thanks, Kelso. It was great chatting with you. I think a lot of people could benefit from thinking differently about money in general. and then insurance in specific. I think the behavioral psychology around money, around stuff like insurance, around risk, around reward, we have a ways to go. I think the human psyche is not there yet where we really understand these things. And so thank you for bringing a little bit more perspective to how we might think about insurance as a tool beyond thinking of insurance as a cost.
Wonderful.
Yeah, my pleasure.
Guys.
Thanks, guys.
Well, Adrian, that was a pretty informative conversation. Always love talking with Kelso. You mentioned a couple of times about his accent makes almost everything sound a lot better. But what were your big takeaways from that conversation today?
Yeah, I think any good conversation with Kelso is really interesting. He's got a lot of perspective on insurance in general. My takeaways, I really just hope that the people listening to this have a little different perspective on how they think about insurance. I hope we found reasons to alleviate any of the negative thoughts about it, because I think it is a really valuable tool. And that doesn't mean not every hammer wants to find a nail. Just because you've got a tool doesn't mean there's only one way to use it. And obviously there needs to be a lot of tools in the toolbox. And if insurance isn't the right one for the client, that's fine. But I really hope that the people listening see it as a tool they should consider in their arsenal.
Yeah, absolutely. And I think it's our job and jobs of financial advisors, and especially ones that hold the certified financial planning designation, to really go out there and let people know that this sort of thing exists, and whether it's a good fit for them and their family and their needs is what we do in gathering all the information and building the financial plan. But to understand that it's not just your RSPs, your TFSA, and then go right to non-registered, that there is this other asset class out there that might be a good fit for them to help build wealth and also transition wealth to the next generation. One of the things that we didn't get into a whole lot, because this could be something we talk about ad nauseum for hours and hours and hours, because it is such a big topic. But we're looking at this great transfer of wealth that's happening over the next several years, and it's already started. And we're talking trillions of dollars in Canada, moving from the boomer generation to millennials and into Gen Z. And there's going to be taxes that are going to be paid, and there's a way to now transfer this or help transfer this in a more tax efficient way to help the millennials and help the Gen Zs get that extra step up, because they aren't having the same sort of income levels and standard of living that the predecessors had or the boomers had. So, if they can help them out, there might be a good way to transfer that wealth in a tax efficient way. And there's also a really good way to help build their wealth even throughout those retirement years. So I think it's a really good conversation. I think it's a conversation we need to be able to have with our clients.
Yeah, absolutely. I think one of the other interesting parts, is just how applicable insurance still can be to a 60 or a 70-year-old. I think the default line of thinking would be that insurance is for 25-year-olds with mortgages and young families that need protection. But when you start treating insurance like a strategy, like a tactic, it can still be perfectly reasonable that tactic might apply for a 60 or 70-year-old. Is the insurance going to cost more because you're older? Yeah. That doesn't mean it's not still a better option than other alternatives you're looking at. And so I think it's really interesting to consider that can still work. It can still get through underwriting. You can still do things to deal with the medical issues that might crop up when you're applying for life insurance. All of it. I find that really, really interesting.
Yeah, and he kind of touched on it a little bit, and I think we moved on pretty quickly. But when he was talking about some of these older people that are looking at life insurance, if you do a joint policy, you can have it where if there is someone that doesn't have as good a health, because it's based on two people and it's going to be the last to die, they typically look at the healthier person. So you could have that coverage for both people in a family, and still have them both insured under that to help out. So there are some interesting pieces like that. It's wonderful having someone like Kelso to be able to bounce these ideas off of, or bring a case to him and say, I've got this client who I don't think can qualify, and he can look at it because he sees so many deals go through that he can actually find that correct policy with the correct provider as well.
That's exactly what I have used Kelso for in the past. We have had exactly that conversation about some of my clients, certain medical issues, which carriers would be, potentially interested in taking on this particular set of medical issues, and he can help get an answer, because there's no point wasting time applying to everywhere. Like you said, there's 20-ish carriers that they work with. It would be a disaster to apply to all 20 carriers and then see who says yes. Like, let's do some field underwriting first and get the policy in front of the right carrier. And this is a lot of the value I think that he provides to us in our business, but ultimately that funnels down to the client who gets a better service from us because the information is available to us.
Yeah. At the previous place that I worked, we had two, maybe three. And it wasn't even the full suite of products that were available from any of the companies. So, there was a lot of no's if it didn't fit into a very specific little bubble of what the expectations were. Whereas here, having those 20 providers, there's a lot of different places that will take on different appetites for risk. So, it's pretty amazing. Great talk with them. If anybody has any questions about insurance, please reach out to, somebody that is insurance licensed. Adrian and I are happy to have that conversation, and we could pull on people like Kelso to help out with any of that as well. So what a great conversation. So happy to have him on.
Yeah, it was a great topic. Thanks, Trevor, for today's recording. I hope everybody has found something valuable out of this.
Wonderful. Thanks, Adrian. Have a great one.
Take care.